So as I was talking about before, it's very important to understand the commercial and residential real estate markets. Most financial institutions, particularly regional banks and local banks, have significant exposure to the residential and commercial real estate market cycle. So to understand financial institutions, particularly the asset side of the balance sheet, the mortgage-backed securities, the muni bonds, and the loans, you have to understand the underlying fundamentals of commercial and residential real estate markets. And that'll be this next section. So the first thing, most institutional investors, real estate investment trusts, real estate operating companies, pension fund advisors, pension funds, banks, hold mortgages or hold direct properties or hold securities, real estate-backed securities within their portfolio. The portfolio theory is that you add assets to your portfolio, or your asset side of the balance sheet, where the returns on those assets have low, no, or negative correlation with each other. So as you add more assets, more mortgages, more securities to your portfolio that have low, no, or negative correlation in the rates of return, you can diversify the portfolio. As you add more assets, the unsystematic, non-systematic, diversifiable, business-specific, real estate-specific risks are diversified away. So that the only thing that's left is the systematic risk, the market risk, the economic risk that's left in the portfolio. Now the thesis is that leading up to this section of the presentation, I have presented to you external risks associated with the economy, both at the macro and the micro levels. We talked about economic risk, fiscal policy risk, monetary policy risk, credit risk, bond market risk, stock market risk. So the financial crisis, in my view, along with the other financial crises beforehand, particularly the 2001 to 2003, the 91 to 93, and the early to mid 80s, and the early to mid 70s recessions, creates volatility and creates risk for risk managers to be able to mitigate. You have to understand that recessions and market crises are a natural phenomenon. And if you're going to be a risk manager, you have to understand market risk, and to be able to be a risk manager, to put in place contingency plans and risk mitigating plans within the portfolio. Either be bonds or securities or property. But the fact is, since 1994, with the peso devaluation, the Thai baht crisis in '87, the Russian defaults in '98, the dot-com bust in 2001, the housing bust in 2008 and 7, and the financial crisis, we as financial managers are now subjected to even more structural risk, more systematic risk, more political risk, economic risk, market risk, and non-diversifiable risk. So where before, in stable markets, with a lack of volatility, it was very easy to diversify the portfolio, reduce the non-systematic component to get to the systematic component reflected in the beta. But now, after the financial crisis, and really the financial crises before that leading up to the great financial crisis, we as investor and risk managers are facing more systematic risk. So the question then becomes, how do you solve the systematic risk? What do you do to mitigate systematic risk? The way that you mitigate systematic risk is through micro risk. By trying to push down the systematic risk and increase the diversifiable risk. So if you're confronting interest rate volatility, credit risk premiums, illiquidity risk premiums, more volatility, more instability going forward, the way that you manage a financial institution is now to focus on the micro market, the microeconomics, And what are those factors? You have to focus on your client base. Who are the current borrowers that you have relationships with? And nurture those relationships. You have to hire the best talent. You have to have training programs in place, and you have to be able to select the best talent in your company, in your corporation, in your financial institution. You have to deploy and implement the best technology. Big data applications, data analytics, CRM applications, accounting systems, risk management systems, investment management systems. You have to utilize the technologies and the tools available to you so that you can do a better job of the investment and the risk management. And you have to apply the 80-20 rule. 80% of your revenue is coming from 20% of your client base. You need to focus on that 20% before you start to expand and look at market share expansion. So using microeconomic, looking at the institution, looking at the customers, and upgrading the platform is a way to immunize yourself and sterilize yourself from more macroeconomic risks. And I just don't see a lot of institutions doing that. Modern and postmodern real estate portfolio theory. We just talked a little bit about it. But why real estate? Why put real estate in your portfolio? It's because it's one of the biggest asset classes out there. It's the commercial real, and these were numbers that were done about 5 years ago. So commercial real estate right now is at least $10 trillion globally, and that's actually 10 trillion in the United States right now. 3 trillion or 33 trillion globally. Commercial real estate as a total to the capital markets, 16 trillion in equities, 25 trillion in debt. You can just see the size of residential mortgage-backed securities, whole loans, real estate as investments. So you have to have exposures to real estate. That's why financial institutions have such large exposures to real estate, because it's such a huge component of the capital markets, and retail investors too. So looking at the efficient frontier in real estate within a capital markets context, you start with the capital allocation line and the risk-free rate. You have the efficient frontier. You have the efficient frontier umbrella. And what's missing here is the utility curves. Utility curves. So the utility curves, most investors want to be up here. They want high return and low risk, but there's no investments in the capital markets to invest in that provides that high rate of return at that level of risk. So what they have to do is they have to lower their utility to get to the tangency of the efficient frontier in the capital allocation line. It's the point at which the utility curve is tangent to the capital allocation line and the efficient frontier. That is the market basket. That's where the majority of risk-averse investors land. That is the market basket. So if you were to look at the market basket, you would take real estate, which is roughly 10% of the tradable assets in the capital markets, and you would allocate 10% of your portfolio to real estate. You would allocate 30% to equities and the rest to fixed income. There might be a sliver in there for commodities. If you want to take on more risk, you would go out on the efficient frontier and start to over-concentrate in equities. This is a 100% stock portfolio. If you wanted to mitigate your risk and take a lower rate of return, you would creep down the efficient frontier and have a higher proportion of your portfolio in bonds. If you introduce real estate to your stock bond portfolio, the efficient frontier bows out. So actually, yes, you're going to get lower expected return on the portfolio, but the portfolio standard deviation is going to be reduced significantly more, so that the return to risk ratio goes up significantly. So if I'm a risk-averse investor, putting real estate in my stock bond portfolio bowing out the efficient frontier. Yes, I'm going to get a lower expected rate of return on the portfolio, but it's going to reduce the portfolio standard deviation or risk significantly more. Therefore, my return to risk ratio is going to go up, which means that me, as a risk-averse investor, are going to be better off. Now, why does real estate bow out the efficient frontier? Because real estate, unlike stocks and bonds, have inflation hedged attributes. For example, in commercial real estate, most commercial real estate leases have CPI adjustments embedded in the lease contracts. So if I sign a lease with a tenant and they're paying me rent, the lease rental income from that lease will go up with the inflation rate because there is a CPI adjustment embedded in the lease. Is that true for bonds? Are bond coupons tied to the inflation rate? No. Are bond principal that's paid back at the end of the term tied to inflation? No. Are equities tied to inflation? Do the dividends track inflation? Yes and no. More so no than yes. The equities do have an inflation component to it, but not as robust as commercial real estate. Commercial real estate takes a lot of maintenance. Do you have to put a lot of money to maintain this property? Yeah, because you need to paint it, you need to keep the exteriors up, you got to make sure the foundation has integrity, you need to replace the roof, you might have to do some seismic upgrades at some point in time. The money that you're putting into the property on a constant basis are inflation-adjusted dollars. It's return of, not return on, it's return of. So not only are you getting CPI adjustments in the income stream, but you're putting capital expenditures into the property that increases the cost basis, preserves the property to make sure it doesn't physically deteriorate or become functionally obsolete. And those inflation-adjusted dollars invested in the property through capital expenditures inflates the terminal value at the end. So the value at the end, due to CapEx and the CPI adjustments in the income, makes real estate an inflation hedge that stocks and bonds do not have. And if inflation and inflation expectations are expected to go up, what happens to interest rates? They go up. What happens to bond prices? They go down. They go down. If inflation expectations go up, interest rates go up, and bond prices go down. If risk-free rates and expected rates of return and discount rates go up more than the growth rate expected in the free cash flows, the dividends, the earnings per share, the EBIT, the EBITDA per share, when you're valuing a stock, if interest rates go up or discount rates go up faster than the growth rate, then the stock prices go down. So stocks and bonds, their prices are inversely related to inflation expectations, and interest rates. So as inflation expectations, interest rates, expected rates of returns, and discount rates go up, bond prices and stock prices go down. As inflation expectations go up, the rental income in a property goes up because there's a CPI adjustment embedded in the lease contract. And as inflation expectations go up, the money that they're putting into the property, they're using inflation-adjusted dollars in their capital expenditures, therefore maintaining the property and getting a return on cost. Stocks and bonds do not have that. So stocks and bonds, compared to real estate returns, have low, no, or negative correlations. So real estate returns, if they have low, no, or negative correlations to stocks and bonds, if you add real estate to the stock bond portfolio, it's going to bow out the efficient frontier. It reduces the risk. It reduces the risk more than the return reduction. Therefore, you get high return to risk ratios, and you are better off as a risk-averse investor. So here's the efficient frontier. And the efficient frontiers and the plotting of the efficient frontiers by asset classes is pretty straightforward. You calculate an expected rate of return if you have the total return for the asset classes on whatever time interval. You calculate the mean. From the time series, you can calculate the standard deviation. If you know the average return or the expected return, and you have the standard deviation, you can plot it on an XY coordinate. X-axis, standard deviation, y-axis, expected return. Here are the plots for the different asset classes to test. NASDAQ composite of stocks, high risk, high return. You have the NAREIT index. The REITs shares trade on the New York Stock Exchange. Totally makes sense that they're going to be closely correlated to the equities. You have the NAREIT FTSE, which is the global Dow Jones stock, S&P 500, Russell 2000, Russell, S&P utilities, bonds, and government bonds, municipals. And real estate would be probably in here somewhere. So if you are building a multi-investment sector portfolio, what would be the target allocation that you would recommend to your institutional investors that are going to be investing billions or trillions of dollars over the next 20, 30 years? What would be that mixed asset portfolio allocation? Usually it was just 60 years ago, it was just stocks and bonds, 30-70. Then in the 1980s, real estate was introduced and got 10% of the allocation. Then in the 90s, insurance products at the institutional level were introduced, got 10% from the stocks and bond allocation. And now going forward, you're seeing energy being introduced. New renewable energy, equities, debt, IPOs, infrastructure that institutional and retail investors are now starting to expose themselves to. So I believe that the target allocation, because after the financial crisis, stocks and bond volatility was extremely high. And since risk-averse investors do not like volatility, they are going to take from the stock bond allocation. We already know insurance is going to get 10%, real estate gets 10%, so now energy will get 10%. So if I was going to build an institutional portfolio allocation to maximize risk-adjusted rates of return over the next 20, 30 years, I would allocate the portfolio 45% bonds, 25% stock, 10% life insurance, preferably the underlying whole life insurance product, 10% real estate, and 10% energy. And that should be the market basket going forward. That should provide the highest risk-adjusted rate of return over a 10, 20, 30-year period with the least amount of portfolio risk and the highest return to risk ratio. So here's an example of just a basic calculation. This is an application in mean variance to commercial real estate. This was an actual presentation made by me to the board of directors and the investment committee at the REIT. They asked me to build a portfolio allocation for the real estate portfolio, for the apartment portfolio, multi-billion-dollar portfolio, and they wanted to know what markets they should be concentrating on. Because they had exposures in Albuquerque, Tucson, Salt Lake, Seattle, Riverside, LA, Northern California. So they had markets all over the western region. What I did was I found some income capitalization rates on a quarterly basis for apartments. I also had prices per square foot on a quarterly basis for the apartment markets within our region. I added the capitalization rate for the quarter, which is an annualized income return, plus a year-over-year change on a quarterly basis. So I got capital appreciation plus the income return gave me the total returns. Once I got the total returns for the apartment markets within our region, I could calculate the mean return, expected return, total return, and the standard deviation. So I could calculate the average returns, the standard deviations, then divide the total returns by the standard deviation to get the return to risk ratio, then sort by return to risk ratio. Because what I was looking for was what markets provide the highest risk-adjusted rates of return, or what markets provide me, the company, the highest return per unit of risk. And the top markets, Orange County, San Francisco Bay Area, Seattle, San Diego, and Los Angeles. The attributes of these markets: highly supply constraints, high barriers to entry, high concentrations of tech companies or military tech companies, gateway cities with ports and other types of intermodal transportation nets. So markets with attributes that are replicatable, that basically have the attributes that channel capital to them, create clustering of firms, jobs, and capital, and they're supply constrained. Sacramento, Denver, Portland are really hybrid markets between supply constrained, high-tech markets, and commodity markets. Commodity markets: Salt Lake, Phoenix, Tucson, Riverside, Las Vegas, and Albuquerque. All of these markets have a lot of land. All of these markets, municipalities and economic development agencies, use commercial and residential construction development as economic development policy. So these markets are prone to boom bust. High demand on the labor side, high demand from population and household growth and formation, lots of land, lots of supply. Boom bust. So obviously they are going to have the highest standard deviations and the volatility and the lowest rates of return. So just from this basic chart of return to risk ratios, we came to the conclusion that we should not be in these commodity markets because the rates of return were negative on a real basis. I mean, look at Albuquerque. Total rates of return over the extended time period were 2.4%. If inflation is running at 3, we're getting negative real returns. We should not be in Albuquerque. Riverside was 5, so we only get a 200 basis point premium to go into Riverside. Doesn't really make sense. What we want to do is we want to go into markets that are providing returns well above our weighted average cost of capital. And if our weighted average cost of capital is 12%, or maybe 14%, we don't want to be in a lot of these commodity markets. And they sure in the heck don't reward us on a return to risk basis to be in those markets. So the firm, after looking at this analysis and subsequent analysis, made the conclusion to divest in these commodity markets and redeploy the capital after paying off some debt to bring down the leverage, set up a line of credit, and then deploy aggressively capital in not only acquisitions but also development in these core high-tech supply-constrained markets, and go out on the efficient frontier by over-concentrating, eliminating a lot of geographic diversification, but really reaching for returns by over-concentrating in supply-constrained markets, high-tech markets, gateway cities, and take on the risk of going out on the efficient frontier and over-concentrating and giving the investors a higher rate of return, yes, at a higher level of risk, but we've done the market analysis to show that these are the outperforming markets. You shouldn't be in these unless you want to be a risk neutral or contrarian or opportunistic. If you're a risk-averse investor, core investor, institutional investor, a retail investor that wants income through dividends, you want to be in these top 5 markets. And again, you can see, what markets currently have the most supply. Orlando, Dallas, Houston, these are all commodity markets. They're all in Texas. They're in the South. Most southern and Texas states have a lot of land. They promote development. They have a lot of supply. The ones that are supply constrained, Orange County, Seattle, LA, San Diego, San Francisco, supply constrained. So from a portfolio strategy, a portfolio style, if I was going to be running a bank and I was going to be lending on commercial and residential real estate, or if I was a real estate investment trust or real estate operating company or a real estate private equity firm, I would probably be focusing on these supply constrained markets, because in the end, you're not only getting higher returns, real returns, but you're getting higher return to risk ratios or higher risk adjusted rates of return. If you want to go into these commodity markets, you better know how to play the cycle, you better know how to get in and out. But institutional investors, REITs and REOCs, and institutional investors are buy and hold investors, they're perpetuity investors. They buy for the long run. They do not trade the markets. So the markets that provide the highest risk-adjusted rates of return over the long run are the commodity, high-tech, concentrated port city markets. Let's cut it. Where are we in time?